You know how when you get your paycheck, you do what you're supposed to do? Pay the bills, save what's left, maybe treat yourself a little. Now, fast forward 20 years, you're comfortable but not rich. Just fine. Meanwhile, someone who grew up with less than you, who made less than you for most of their career, retires with millions. Same country, same banks, same tax forms. So what happened? It's not that they found a secret bank account. It's not a lucky stock tip. Somewhere along the way, they learned rules about money that nobody sat you down and taught you. Not illegal rules, but rules that only get passed down at certain dinner tables, in certain boardrooms, in financial advisor offices that don't take walk-ins, and in this video. Today we're breaking down 10 of them. Real rules that separate people who build wealth from people who just earn money. And by the end, you're going to realize the biggest one isn't even about money at all. Most of these rules aren't complicated. They're just inconvenient. And once you hear them, you'll understand why. Rule 1. Assets buy you freedom. Liabilities buy you stuff. Most people think an asset is anything expensive that they own. Your house, your car, your watch. Rich people use a much colder definition. An asset is something that puts money in your pocket. A liability is something that takes money out. Price tag doesn't matter. Direction of cash flow does. That $90,000 truck is a liability. It loses value the second you drive it home, and it costs you gas, insurance, and repairs every month after. A $90,000 rental property, that's an asset. It pays you rent every month whether you think about it or not. Rich people don't skip nice things because they're cheap. They skip them because a boat is a hole in the water you pour money into, and they'd rather pour that money into something that pours back. Rule 2. Debt is a tool, not a trap. Say the word debt, and most people picture credit card statements and stress, fares. But rich people split debt into two totally different categories most people never separate. Bad debt buys things that lose value the moment you own them. Vacations, gadgets, cars you can't afford. Good debt buys things that make you money. A rental property, a business loan, an investment that pays more in return than the loan costs and interest. Same 3 letters, but a totally different animal, depending which side of the ledger it's feeding. Rule 3. Pay yourself first. Here's how most people budget. Income minus expenses equals whatever's left over as expenses equals whatever's left over to save, which is usually nothing because expenses have a way of expanding to fill whatever's available. Rich people reverse the order. Income minus savings and investments taken out immediately equals what's left to live on. The bills get whatever's left over, not the other way around. It sounds almost too simple to matter. It isn't. Reversing that one line item is the difference between I'll save whatever's left and actually having something left 30 years from now to show for it. Rule 4. Cash isn't just sitting there. It's a position. Most people see cash in a bank account as money that's doing nothing, losing value to inflation while it just sits. And technically, they're right. But rich people know cash has a job even when it's not invested. It's ammunition. When markets crash and everyone else is panic selling, the people holding cash are the ones buying real estate, stocks, and entire businesses at a discount because they had the one thing nobody else did in that moment. Money that wasn't already tied up. Idle cash isn't wasted. It's a loaded position, waiting for the moment everyone else is forced to sell. Rule 5. Lifestyle creep is the silent wealth killer. When you get a raise, you feel like you earned an upgrade. A nicer apartment, a nicer car, a nicer everything. Totally normal. Also, the number one thing that keeps people from ever getting rich. If your spending rises exactly as fast as your income, the gap between what you make and what you keep never grows. You can triple your salary over a career and end up with the same $0 saved, just a nicer zero. Rich people don't necessarily earn dramatically more than everyone thinks. A lot of them just let the gap between income and spending get wider every single year instead of staying flat. Rule 6. The bank comes to you. Below a certain balance, you go to the bank. Above it, the bank comes to you. Once your assets cross a certain threshold, banks assign you a personal banker, waive your fees, and offer you loans and investment deals that were never listed on the public menu at all. It's the same bank. The rules just change once you already have enough money that you technically don't need them to change. That's not a conspiracy against you. It's just how the business works. Access breeds more access. Rule 7. Never sell it. Just borrow against it. This one sounds like a magic trick, and functionally, it kind of is. It's real, documented, completely legal. Wealthy investors call it buy, borrow, die. Here's the logic. The government taxes you when you sell an appreciated asset. Stock, real estate, whatever. So the rule is simple. Don't sell it. Instead, borrow against it. Banks will hand you a loan using your stock portfolio as collateral. at a lower interest rate than you'd get anywhere else with no requirement to pay it back on any particular timeline. You live off the loan. Your assets keep growing in value the whole time. And when you die, your heirs inherit those assets at their current value, which, under current tax rules, erases the growth that happened while you were alive. Tax-wise, in one clean stroke. You are never required to sell, which means on paper, you are never required to pay. Rule 8. Your network is a balance sheet. Ask a wealthy person how they found their best investment, their best deal, their best hire, and shockingly often, the answer isn't a website. It's a person or dinner or a phone call from someone who already trusted them. Wealthy circles function like an information network that never gets published anywhere. The deal, the job opening, the early warning about a company in trouble, all move through relationships first, and the public second, if it reaches the public at all. Who you know isn't just nice to have. In these rooms, it's treated as an actual asset, sitting on the balance sheet next to everything else. Rule 9. Own the thing that produces the income. Most people spend their whole career trading hours for a paycheck. That works right up until you stop working. Rich people focus on owning the thing that produces the money instead. The business, the property, the portfolio. The paycheck earner has to keep showing up forever. The owner gets paid whether they show up or not. The same effort, different ceiling, and a completely different retirement. Rule 10. Time in the market beats timing the market. Everyone wants to buy at the exact bottom and sell at the exact top. Almost nobody, including professionals with entire teams and algorithms, can actually do that consistently. The people who build the most wealth usually aren't the ones making brilliant, dramatic trades. They're the ones who bought decades ago and simply never touched it, riding out every crash, every panic, every headline telling them the sky was falling. Because 30 years of patience beats 30 days of perfect timing almost every single time. Now a few things that deserve a second look. First, none of these rules are illegal. Not one. Second, none of them are even really secret. They're just not taught, not in school, and definitely not by an industry that profits more when you don't know them. Third, and most important, these rules compound. A behavior you repeat for 1 year is a habit. Repeat it for 30, and it's not a habit anymore. It's a different life, but it's worth being honest about something. Rules 6 and 7, the private banker, the borrow instead of sell trick, those require you to already have money before they'll work for you at all. That's not a level playing field, and pretending otherwise would be dishonest. The other rules, though: assets over liabilities, good debt over bad debt, paying yourself first, keeping the gap between income and spending wide, patience over panic. Those don't check your bank balance before they let you in. So think back to those two people from the beginning, same paycheck, same starting line, decades apart in where they landed. The paycheck was never the difference. The rules were. So which ones are you already breaking?